Hello again, this is Dr. Zek. Today I'm going to walk you through some important steps that you must take when you are investing in real estate. This is one of the videos in a series which I call Real Estate Investments. I suggest you watch the other videos in the series so that you get a clear and full picture of all aspects that are involved with real estate investment. I'm going to walk you through 8 steps that you must take when you're securing real estate. This could be house, commercial building, land. As long as it is fixed property, the steps apply. So without wasting time, let's dive straight into it. Step number 1, you must understand the investment strategy that you want to follow. Flipping versus rental income. Property flippers buy and sell. So they are not buying to hold, but they are buying to sell, just like any other buying and selling business. The aim of flipping is normally to make a quick profit. So they normally target auctions, distressed property market, where people are failing or struggling to finance their repayments and they need to sell. The money that you get from flipping a house is usually active income, which means you have to continuously actively working for it. Rental investment is whereby an investor buys a property to hold it and to derive some rental income from it. Rental income is passive income. For one, I prefer investing for rentals, just for the very reason that it is one that is used to achieve financial freedom, and is also the one that usually is used to create generational wealth. Step number 2 is to raise capital. As I alluded in the other videos, investing in real estate requires a bit of capital. There are different sources of capital that you can use. Some people who are really cashed up, you can use your personal savings. If you've got the money, go for it and start with your personal savings. The amount you might have saved might not be enough to cover the whole cost. You might need to borrow. So what I encourage is save as much as possible and then offset the rest with the borrowing, either from a bank or from family. Banks require surety for them to give you substantial amount of cash. They do some assessments to find whether you are credit worth, also determine how much they can lend you in the form of a mortgage. You must also understand the difference between fixed rates and variable rates and the advantages and disadvantages. Let's go to step number 3. Step number 3 is to go on the market, to look for that house, to look for that commercial building, to look for that land. The most important thing to bear in mind is the location. That's why they always say location, location, location in real estate, because it makes a huge difference. If you invest in a poor location, it can have a lot of negative repercussions in terms of your rental yield. Even if you are flipping, it can also make a difference between the amount of profit you can make. You might also be limited with the amount of cash you have. So you might have to sometimes suck it up and just start somewhere. That's why I always say start with what you can, and you can always expand. So if you start by killing yourself trying to purchase in the CBD and it's your first property investment, you will not like a real estate investment. Don't try to compete. People who are buying those CBDs are usually using passive income. They've been in the investment game for a long time. Step number 4, look around, shop around, take your time. You remember this is a huge investment. Remember this involves a huge amount of capital, possibly some debts as well, that is going to cost you your leg and arm. So you better be careful. Some recommend that you do 50 to 100 property views before you even consider selecting one. So do as many as you can. I recommend that you do not less than 15. Don't just view 2 or 3 properties and then you choose one. There are some few things that I also want you to be checking and looking around and considering when you're looking for those properties, especially if it is your first investment house. First of all, you may need to go to high densities, for a reason that high densities usually have higher return on investments versus low density suburbs. Low density suburbs are very expensive, but also the return on investment, if you calculate it, it is usually lower. I will do another video when I compare investing in the low density and in the high density. Look for the ugliest house on the streets. It's usually the cheapest because it's ugly. So you get a very good deal when you get an ugly house, as long as it has got a good, decent yard. Get that ugly house and renovate it and put some tenants. That ugly house, we're gonna convert it to make money. You'll be surprised how much you'll make out of it if you follow the steps that I'll be going to teach you in other videos. Money in real estate is made when you buy the property and not when you sell. So you try to get the best deal on buying, because when you make a mistake on buying, you overpay. It will be very difficult for you to make any meaningful money from that. I'm not suggesting that you rip off people, but that you don't get ripped off. So I'm protecting you from the people who overvalue their property unnecessarily, because you are aiming to make money in this. This is a business. This is an investment. I'm sharing with you these nuggets. These are the secrets of rich people. They normally don't share these things. I'm trying to make you rich as well by giving you this free education. You pay for consultancy to get this information that I'm giving you, but I'm giving you for free. Just your data that you're using for YouTube. So if you like the content, press the like button. And also please subscribe. Also in the comment section, tell me what you think about purchasing the ugliest house on the street. You must always aim to get an opportunity to put a cottage on any property, to make them at least 2. Make them duplex, triplex. It's always a big advantage. 1 house versus 2 or 3 on the same property. If there's something that you're going to get from this video, is always look out for the opportunity to put as many houses as possible on one property. It pays more in the long run than a single unit. Trust me on this one. You thank me later. You're welcome. Step number 5, you must do your due diligence before you do any purchase. Check all the documentations, check all the paperwork. Go to the deeds office and check everything and do everything according to book. If you're not confident enough to do it yourself, please use people who are legally qualified to do that. Consult your conveyancing lawyers. Involve them as an extra layer of proof, of checking. But don't rely on legal experts 100%. They can also be duped too. The criminals are becoming more and more sophisticated, especially where it involves lots of money. So the onus is upon you. It's your money, it's your capital, and it is your responsibility to protect it as much as possible. You want to make an income, you want to create generational wealth. Check the ownership and make sure there's no double selling, and make sure the person who is selling you is the one who legally owns the property. Also, make sure the land you are trying to buy or the land you are going to buy is not under disputes. Some people sell to shed off problems, to pass on their problems to the next person. They realize that the land is under dispute or the property has got some disputes. They quickly want to sell it off so that they shed the problem off from them and to you. There are cruel people out there. Step number 6 is now to negotiate the price. You want to pay the least you can. Money is made when you buy and not when you sell. So you want a high level of negotiation skills to make sure you get the best deal. Pay a fair price, yes, but also avoid paying an overvalued asset. It's going to be difficult for you to make money from an overvalued property. There are some ratios and some rules and some calculations that you can do to assist you with how you can determine a property price. I will do another video which will give you some clues and some suggestions. The ratio that I like the most is the return on investment. To calculate the return on investment of a property, you add up the total rentals for the year and you add up or sum the total expenses for that year on that property. Then you subtract the total expenses from the total rentals or the total income. That figure you divide it by the amount you paid for that property. And then you multiply it by 100 to make it a percentage. A good return on investment is usually above 7. 6 point something is acceptable. In most houses in developed countries, it's usually less than that, like 3-4%. It's very easy for you to make a return on investment of 10% or 12%. I usually like it above 10%, at least 10%. If you buy the property at a low cost, your return on investment can be as high as 15 to 30% or even 50%. It depends on how you negotiate your deals. Anything above 10%, it's lucrative. You're in business. It means also your payback time is going to be shorter. You're going to get your investment money back quicker. It's called the payback period. Step number 7, when all is done and dusted, here comes the time to strike a deal. You've done your due diligence, you've assessed, and then you must make that final decision. Take that final risk. You've done all you can, so it's a calculated risk. If you keep analyzing and analyzing and analyzing and over-analyzing, you won't get anywhere. So when you think you have done everything that you need to do, it's a time to strike the deal. It's the sign to sign it off. Get approval if it is a bank loan. Finalize everything. Do your papers. Transfer the names. Pay whatever you need to pay. Get that agreement of sale. That document is very important. And also make sure the ownership is transferred into your name and you close the deal. Step number 8 is the final aftermath. You've got your new purchase. Congratulations. What I suggest to you is, if it is just land you purchased, start development straight away if you can. This will ensure that if there's some disputes, you know of them quicker. And you want to be the first one to be digging foundation on that property in case several people were sold that land. When you start developing, you start noticing if there are some disputes as well. People start turning up. If it is a small core house, start renovating. If it is a full complete house, start moving in or putting in your tenants. That is the final step. If it is your first house, this is the beginning of your journey towards generational wealth creation. This can be a journey towards your financial freedom. If it is your second house, if it's your third house, If it is your 10th house, still you're adding to your portfolio. Keep repeating the cycle as many times as you can. This is how people achieve financial freedom, and this is how people create generational wealth. If you like the content, press the like button and please share the content with your beloved ones. Please subscribe if you haven't subscribed yet. This is Dr. Zek signing out.